Imagine you walk into a giant grocery store, but instead of fruits and veggies, every aisle is packed with companies. Apple, Microsoft, Tesla, even your favorite sneaker brand, Nike, they're all there. Now, what if I told you there's a scoreboard that tracks how well this entire store is doing? That, my friend, is basically the S&P 500. And trust me, it's a way bigger deal than your fantasy football league standings. Okay, let's break it down. It's like the popularity contest of the stock market, but instead of high school, it's for the 500 biggest, baddest companies in the US. We're talking the A-listers. If a company is huge and successful, chances are it's in this club. Think of it like this. If the stock market were a pizza, the S&P 500 would be the extra large, extra cheesy slice that everyone wants a piece of. Why? Because it gives you a snapshot of how the whole US economy is doing. If the S&P 500 is up, businesses are generally thriving. If it's down, well, maybe hold off on buying that gold-plated toilet. Now, you might be thinking, cool story, but why does this matter to me? Great question. Your money might already be in it. If you have a 401k retirement account or even just a mutual fund, there's a very good chance part of your money is invested in the S&P 500. It's like the default setting for growing wealth over time. When people say the market is up today, 99% of the time they're talking about the S&P 500. It's the gold standard for measuring how well investments are doing. If your stock portfolio is crushing it, but the S&P 500 is crushing it even harder, well, time to rethink your strategy. It's boring, in a good way. Unlike meme stocks or crypto roller coasters, the S&P 500 is the slow and steady tortoise that wins the race. So unless you're a gambling addict, this is your best bet for long-term growth. Here's the fun part. The S&P 500 isn't just a random list. It's weighted by market cap, a fancy term for how much a company is worth. Let's say the S&P 500 is a smoothie. Apple, Microsoft, Amazon? They're the big chunks of strawberry. You taste them way more. Smaller companies? They're like the spinach, still there, but not as noticeable. So if Apple's stock jumps 10%, the whole smoothie gets way sweeter. But if a tiny company crashes, mwah, barely a blip. Not just any company can join the S&P 500. There are rules. Must be a US company. Must be worth a ton. We're talking billions. Must be profitable. The S&P 500 isn't just some random index. It's the heartbeat of the economy. Governments, businesses, even your retirement fund manager stare at it like it's the magic 8 ball of finance. So if you want to grow your money without turning into a day trading stress ball, then yes. The S&P 500 is the set it and forget it superstar of investing. So next time someone says, the market's up, you can nod wisely and say, ah yes, the S&P 500, a fine day for capitalism. And that, my friends, is why the S&P 500 is kind of a big deal. Now go forth, sound smart at parties, and maybe, just maybe, start investing in that cheesy pizza of the stock market.